Okay, hello friends. So, Shri Krishna to all of you and welcome back to my channel. Friends, as I mentioned in my previous lecture, we are going to cover the entire RBI circular on the standardized approach for credit risk, and the circular is just in front of you. So, we will go step by step, chapter by chapter. But before we proceed, this is a small request. If you have not watched my previous video on what is standardized approach and why it is required and why regulation exists, right? So please watch that first. Because in this video, I'm not going to spend time on these basic concepts. We will deep dive into the circular itself, right? So look at the name of the circular. Name of the circular is Reserve Bank of India capital charge for credit risk, right? So the circular itself is telling that capital charge for credit risk is standardized approach. Okay. So what does this capital charge actually means? What is this capital charge? The term here. What is this capital charge? So it simply means how much of the bank's own capital must back the credit exposure. Okay. So to better understand it, a bank is here and it gives loans to customers. Okay. So the moment you give a loan, the risk arises because the money has been shifted from here to some person here. Okay. And this person can default anytime. Okay. So there are other risks also, but majorly the big one is the credit risk. Okay. So the moment you gave the loan, the credit risk have arisen. Okay. So what RBI says? RBI says that you cannot lend 100% using only public deposits. You must keep your own capital behind this loans. Okay. So that's why that how much capital you have to keep will be decided by this Reserve Bank of India new guidelines. Friends, in India, you must be knowing that banks were already following this standardized approach. Those who are working in the risk management division must be knowing that capital charge was already being calculated by standard approach. So what is new in this? So this circular is basically based on the Basel III reforms guideline that the final one which came in 2017, and people also call it as Basel 3.1 or Basel 4. Okay, so this is much granular guidelines, and the exposure classes are much granular. We will see later on this when we discuss the entire circular. But we were already following this standardized approach for capital calculation, right? So you must be knowing that globally there are two major approaches: IRB approach and standardized approach. Okay, RBI is very clear by this circular that banks are going to follow this standardized approach, right? Intention is very clear. The RBI wants uniformity across entire banking space. Okay. Now, before I go deep dive into this circular, I want to take just 2 minutes to explain the mathematical intuition behind the capital charge and the losses, type of losses. Okay. So imagine the bank has 100 of loans. Okay. So if you plot the losses here, if you plot the losses, which is right skewed, so you will get this a normal distribution, some like curve, although it is not normal, it is skewed right side. Okay. Now, if you cut a portion here, this portion is something the bank covers with its provisions, right? And the unexpected portion, which is the standard deviation of expected loss, unexpected loss means the tail risk beyond the expected portion is what capital is meant to be portion. So for this portion, you have to keep the capital. And for the extreme tail risk portion, beyond this point, you have stress loss scenarios, right? Now in India, provisioning is moving towards the ECL based provisioning. We have discussed that separately on this channel, and earlier it was IRAC. Now it is moving to ECL. Okay, but this circular focuses on the capital calculation method. Okay, under the standardized approach. So we will quickly see the distinction between the standardized approach and IRB approach. RBI is clear that they are going to implement the standardized approach. Okay, so under the IRB approach, basically, there are three main differences you can note down here. IRB and many banks are following IRB approach, but in India, this approach has not been given weightage. Okay, So RBI approach is just like banks' own risk models. Banks use here own models. Second, it is a complex process, and there are various methodologies depending on the banks which is using it. Okay, and third one is it is higher, comes with a higher implementation cost also. Right. On the other way, standardized approach gives uniformity, and it is a consistent approach. Okay, consistent approach, and the regulator sets the guideline, and it is comparable across the banks. Right. Okay. So I think this much introduction is enough to go through the other parts of the circular. Okay. The entire circular is divided into 5 chapters. Okay. Okay. So this chapter basically is the preliminary introductory part, which you can tell us. Okay. Chapter 2 comprises of the general instructions, which is very important. Here we will see the due diligence requirement which the RBI has prescribed the banks should follow. Third one is deals with the exposure classes. This is the heart of the circular, exposure classes, and the risk weight. How much risk weight is to be applied for each exposure that is being discussed in this chapter. Chapter 4 is regarding the ECRA. That means external credit risk assessment, how it will be done. And chapter 5 deals with the CRM, that means credit risk mitigation. Okay, so we will go one by one. I don't think I don't want to make this video too long, so I will cover maximum possible in this part and then continue in the another lecture. So we will cover as much as possible here. Okay, so also note this very clearly: the circular is intended to be effective from 1st April 2027, and so banks have time. But on the other way, it also has a big implementation burden on the CBS systems, data mapping. A lot of data has to be mapped, and processes has to be defined. SOPs has to be made. Right. These all works has to be done by the banks. Okay. So this, as you can see, this is the chapter name: preliminary, general instructions, exposure classes, risk weights, external credit assessments, credit risk mitigation, and there are 2 appendices. Okay. Now, there is nothing much to discuss in this preliminary chapter. I already told there are 2 broad methodologies for calculating risk-based capital requirements. One is IRB approach, another is standardized approach, and the RBI has decided to implement the standardized approach for credit risk. Right, and this is the exercise of the powers conferred under Section 21 of 25A of Banking Regulation Act 1943. Here it is important to note that this circular applies to scheduled commercial banks, but does not apply to small finance banks, payment banks, and regional banks. So these 3 banks have been excluded from the purview of the circular, and all other scheduled commercial banks comes under the scope of the circular, and they have to keep the capital charge according to this circular. Right. So I think we have clarified the basic introductory part. And if you want to summarize, we have discussed 4 things here. What is this circular about, and why is this circular issued, and to whom it is applicable, and from when it is applicable. Okay. So this circular is basically RBI is implementing the final Basel III standardized approach for credit risk, and it replaces the existing framework. Why? To ensure a more prudent, risk-sensitive, and internationally comparable calculation of risk-weighted assets. And the new directions will come into effect from 1st April 2027. Okay, and whom we have seen here that this new directions applies to all scheduled commercial banks, excluding small finance banks, regional rural banks. Right. So this is basically a incremental update, and it will require a significant changes to our internal models, data collection, and credit questions. Okay. Next, here are certain terms defined here. We will see as we move forward in the circular. Okay. Now coming to chapter 2, general instructions. Right. So under the standardized approach, RW means risk-weighted assets. Okay. So there is liability in assets. So all the assets here which carries the risk, and RBI has given a certain percentage to treat how much percentage of that exposure is risky. Okay. So under the standardized approach, RWA is calculated just by multiplying the risk weights with the exposure amount. Okay. So that's the core thing. Now, one term you will see repeatedly here is net of specific provision. Okay. net of specific provision. What does this mean? So if your exposure is of 100 and you have kept specific provision of 10, so net exposure is 90 and the risk weight applicable is done on the 9, not 100. Okay, so that's its meaning. Also, you will see here there is a prudential rider given that RBI can adjust the risk weights if needed for a broader systematic stability. Right. So these 2 points are worth remembering. Okay. For the risk weight is calculated, risk weight SLC calculated, and there is a rider. Right. Next, moving to the due diligence requirement. Now, this is where many people miss the spirit of the circular. Okay. So RBI says don't blindly rely on the external ratings. Okay. What does RBI says? That you don't have to blindly rely on external ratings. Okay. So you must do your own independent analysis both at origination and at least annually. Okay. So you have to do the analysis at least annually and at origination. Okay. And now, very important, there is one way conservatism also means if your internal analysis suggests that the risk is higher than the external rating implies, you must move to a higher risk weight, at least one bucket higher. But you cannot use your internal view to go lower than the external rating. Right. Let me explain this because this is an important point. Yeah. Suppose your exposure, some loan exposure has an external rating of A. Okay. So the table assigns risk weight of 50% here. Right. But your internal analysis suggests it behaves like triple B. Right. Then you must apply that higher bucket. But other way, if your internal model say it is which is 100%, but other way, if your internal model says it is double A, you cannot reduce below the external bucket. So that's not allowed. Okay. So that was the main intuition. Further, in the circular, RBI expects a board approved SOPs. Okay, a standard operating procedure which should be board approved. A board approved SOP for this due diligence framework, how you will be conducting your due diligence. Okay, and they even suggest that bank may use PD and climate related financial risk indicators as part of the assessment, because PD helps you sanity check whether the external rate is directionally consistent or not. Right. So even if you are in the standardized approach, you have to calculate PD. It will be useful for you. LGD, it is not mandatory, but it is advised. And PAD. Okay. So this can be used as a appropriate reference to align the assigned risk weights. Okay. And to conduct the due diligence. One exception is given in this circular that this due diligence do not apply to the exposures to sovereigns and central banks. Right. And these are the exemptions actually, and we will visit those when we go to that exposure classes. Okay. Now, I think this is all about chapter 2. So what we have discussed here, chapter 2 basically comprises, gives us the direction, general instructions, which includes calculation of RWA, and next it highlights the due diligence requirement for which a board approved policy is also required, and PD shall be used as an appropriate reference. Now moving to the heart of the circular, that is chapter 3, exposure classes and risk weights. Okay, so in this chapter, basically RBI has defined 15 distinct exposure classes. So what RBI is doing here? Okay, bank must map all its asset, all its exposure, its asset exposure into an exposure class, right? So that capital becomes sensitive to counterparty risk, because each exposure carries a different risk. So first thing the bank has to do is to map its entire assets classes into these 15 exposure classes. Okay. Okay, let's start. The first one is the exposures to domestic sovereign. So this includes direct claims on the central government. Okay. Second, Reserve Bank of India. Third, TICGC. So these three carries 0% risk weight. Okay, this is the safest bucket. right? Similarly, direct claims on state government also carries, means direct loans, securities investments, these also carry the 0% risk weight, right? So where is the distinction here? While the central government guarantees also carries the 0% risk weight, central government guarantees, this also carries 0% risk weight. State government guarantees carries a risk weight of 20%. Okay, so guarantee by state government is not treated the same as a direct claim on the state government, right? Now, the intuition with a simple example is, suppose you have an exposure of say 100 crore, okay, to central government. So the risk weight is 0%. So uh, risk weight assets comes out to be 0, and effectively no capital is required on that exposure. Okay, but there are two conditions also mentioned here, uh, that to qualify for this risk weight. Basically, there are two filters you can call it. Okay, restrictions are, the first one is currency condition, and the second one is the asset quality condition. What is currency condition? That exposures must be denominated and funded in INR. Then only you can apply this. The second condition is the exposure should be standard performing assets, because otherwise, if it is not performing, NPA risk weights apply, and that is separate. Okay. So please remember this: currency plus performance status. Right. Okay. Coming to next exposure classes, exposures to foreign sovereigns and foreign central banks. So, unlike domestic central government claims, risk weights here depends upon the ratings provided by the rating agencies. So, you may be knowing the global rating agencies like S&P, Moody's, and Fitch. So, this provide the ratings, and risk weight is linked to these ratings. Okay, so the highest grade, AAA, AA, this have the lowest risk weight, and mid grades like A, triple B, these have the higher buckets, and the lower grades, which is below B. Okay, so this carries the highest risk weights. Also note that plus and minus modifiers. So you must have seen ratings like this: AAA plus, AAA minus. So this plus minus notations are subsumed within the main category. So there are three practical nuances I want you to remember. The first one is national discretion. Second one is host supervisor conservatism. Okay, and the third one is due diligence exemption. So what is this? Basically, this paragraph talks about this practical nuances. So national discretion means if a foreign jurisdiction allows its own bank to apply a lower risk weight for domestic currency sovereign exposures, then Indian banks may apply that lower weight for exposures in that jurisdiction. Okay. Now, provided the exposure is funded in that local currency. Okay. So, I will repeat it again. If a foreign jurisdiction has exercised its national discretion to allow its bank to risk weight the domestic currency exposure, and it allows a lower risk weight, then Indian banks may also adopt the same. Okay. Provided the exposure is funded in that local currency. Right? This is national discretion. Second is host supervisor conservatism. What does this mean? So, if the host supervisor requires a more conservative treatment than the table given here, Indian banks must follow the host supervisor's stricter requirement for that jurisdiction. Right? And the third one is due diligence exemption. What does this mean? Like we have seen, bank, corporate exposures, foreign sovereign claims generally have exemptions from the mandatory due diligence framework we discussed earlier. So, foreign sovereign claims generally have exemptions from the mandatory due diligence framework. Right? So, just remember these three things: national discretion, house supervisor, and due diligence exemption. Okay? Right. So, we will now proceed to section 9: public sector entities and treatment of local government bodies. Right. So, here RBI's broad intent is domestic PSEs, what we call as domestic public sector entities, right? And local government bodies. These two are not automatically sovereign, right? Domestic public sector entities and local government bodies, these two are generally risk weighted similar to corporates. We will see the corporate table later on, but at this point of time, you must understand that there is no separate table given for these two entities, right? And also, such lending is subject to statutory restrictions on bank lending to government related entities, and that is amended from time to time. and prescribed in the circular also. Okay, right. Now coming to foreign PSEs. Foreign PSEs risk weights typically follow the external ratings ladder. Okay, again, just like any other, just we have seen above, risk weights follow the external ratings ladder, and external ratings agencies are S&P, Moody's, Fitch. Okay, with buckets stepping up. As you can see, the rating beacons, the buckets are rising, and unrated category generally have a standard bucket which is 100%. Right. Okay. Now moving to next section, exposures to MDBs, BIS, and IMF. So this is again a preferred. There is a logic called preferred creditor. Okay. So now this is a special and very interesting exposure class, because the exposures to BIS, IMF, and certain MDBs, which is listed here. You can see a list is given. Certain MDBs, RBI allows 0% risk weight for this. So this is interesting, right? As recognized in the Basel framework also, there are discussions given to the central bank. RBI has listed this 13 entities. You can see here. Okay, 13 entities. So this is a special carve out because these institutions are treated as having extremely strong credit standing, and many have preferred creditor status also. Right. So now for MDBs, which is in this list, this will attract a risk weight of 0%. Okay. And what about the MDBs which are not in this list? So RBI has clarified here that the risk weights are applied as per the external ratings table. So this is the table given for the exposures to other MDBs which are not in this list. Okay. So one subtle point mentioned here, and it's important, that for MDBs, unrated can sometimes be treated more favorably. Okay. So in the other cases, we have seen 100% here, but as in the other categories, but here it is only 50%, which reflects the policy recognition of MDB credit strength. Right. That's all. Now coming to next section, section 11, exposures to bank. Yeah, here it is a bit interesting. So basically, this section covers bank exposures excluding equity and subordinated debt. Okay, so equity and subordinated debt is excluded here, and those are treated separately. Right. So RBI basically for exposures to bank gives two approaches. One is ECRA approach, and other is SCRA approach. ECRA and SCRA. So what does this mean? ECRA? ECRA means external credit rating based approach. External credit risk based approach. Okay. So as the name suggests, this applicable for rated bank exposure. Okay. So this for rated bank exposure. And standardized credit risk assessment approach. This is basically for unrated bank exposure. The exposure which has not been rated. Okay. So we will first discuss the ECRA. That is that exposure which has been rated. Okay. So as the name suggests, external credit rating based approach means ECRA. Under ECRA, risk weights depend on the external rating of the banks. Okay, ranging from lower buckets to very high buckets. You can see it. Okay. Base risk weight is given here: 20, 30, 50, 100, and then 150. Okay. And for short term exposure, 20, 20, 20, 50, and 150. Okay. Now there is a rider here. Again, this is important to note, and many people often skip this. If the exposure has a short maturity, right, say up to 3 months or less. Okay. So if the maturity is less than equal to 3 months. Okay. And for certain trade related instruments up to 6 months. So what is special treatment in this case? The bank and there is also one more condition before I move forward. Maturity condition, that the maturity should be less than equal to 3 months, and for trade related instruments it should be less than equal to 6 months, and the bank is rated at least investment grade, means like BBB or above. Okay. So if these conditions are fulfilled, then a preferential 20% risk weight can apply as per the table rules. Preferential 20% risk weight can be applied. Okay. So you can see it for BBB here it is 50%. Right. And so if these conditions satisfy, you can apply a base risk weight of 20%. And obviously, the due diligence rider remains. Bank must review ratings at least annually, and if internal analysis indicates higher risk, you can move one bucket higher, but never lower than the estimate. Right. Second is SCRA approach. Okay, so here it is interesting. SCRA is for the unrated bank exposure, right? So RBI requires banks to classify the counterparty bank into three grades. Basically, the banks are classified into three grades, and this is grade A, grade B, grade C. Right. For grade A banks, 40% risk weight is applied. For grade B, 75% risk weight is applied, and for grade C, 150% risk weight is applied. Okay. So now what do these grades actually mean? Okay. Yeah. So grade A means that the counterparty meets all minimum regulatory requirements. Okay. So what are the minimum regulatory requirements? There are actually three requirements being discussed here. The first one is about the CET one. You must be knowing capital has two parts, tier 1, tier 2 capital, and under tier 1 there is two parts, CET1 and AT1. So CET1 condition is there. Second condition is capital buffer condition. Capital buffer condition is there, and third one is leverage ratio. This is very important ratio for the banks, leverage ratio. Okay, if a bank meets all the minimum regulatory requirements under these three segments, then it is classified as grade A banks. Okay. But point here is there is a preferential treatment under grade A. So for under grade A, there is also discussed in the circular a preferential treatment is given. So what is this preferential treatment? Yeah, the conditions is that if the bank's CET1, as you know, the Indian banks are much stronger in terms of capital adequacy ratio. So if the CET1 and leverage ratio, so if the CET1 is greater than equal to 14% and leverage ratio is above greater than equal to 5%, right? So the risk weight can drop from 40% to 30%. I've discussed above, the risk weight is 40%. So if these conditions are met, what are the conditions? The CET1 is greater than equal to 14% and tier 1 leverage ratio is greater than equal to 5%. So risk weight drops to 30% in this case. So this is a special preferential treatment, and this is a significant incentive for strong capitalization, right? Now coming to grade B, for grade B, what are the grade B banks? So the counterparty here meets the CET1 and leverage ratio. As you see here, there are three conditions: CET1 condition, capital buffer, and leverage ratio. So grade A banks are those banks, as I discussed, that all the three conditions should be fulfilled. For grade B, the counterparty meets CET1 requirement and leverage requirements. Okay, but may not fully meet the capital buffer requirements. What is capital buffer? That is, you must have heard like CCB. Okay, so this may not be fully met, and but CET1 and leverage ratio are met. So this is like a middle bucket, and accordingly for such banks, 75% of risk weight is applied. Right. For grade C, the counterparty fails core requirements. Okay, then it is classified as grade C. But the core requirements same: CET1 and leverage ratio. CET1 and leverage ratio is not met, and they have an additional red flags like adverse audit opinions and all. So in that case, it's a very risky segment, and therefore if 150% risk weight is kept under the bucket 150%. Right. In this way, the risk weights are applied under the SCRA approach. Now, under SCRA, the assigned risk weights cannot be lower than the sovereign risk weight of the country where the bank is incorporated. Okay, so this is just like the sovereign floor concept, and this matters especially when the exposure is not in the local currency of that jurisdiction. So this is also written. And one important point to note here is the bucketing criteria grade A, grade B, grade C of the RRBs and local area banks and cooperative banks shall be based on the level of CRAR, as CCB is and leverage are not applicable for such banks. So if the minimum CRAR level is met, the banks shall be bucketed under grade A, and banks with having negative CRAR or adverse audit opinion shall be bucketed in grade C, and all other banks are kept in grade B. Okay. Similarly, for the bucketing criteria of AIFIs, shall be based on the level of CRAR only, as leverage ratio and audit opinion as CCB is not applicable for such entities. And if the minimum CRAR and are met, AFI do not have any adverse audit opinion relations to its financial statements, it shall be bucketed into grade A, else grade C. Right. Okay. So this I was talking grade A 40%, 75%, 150%. And this is the special case where the risk weight, this 40% comes down to 30%. Okay. So in the case where this is satisfied. This I have discussed exposures to banks having maturity of 3 months or less. Okay. So that corresponds to the risk weight for short-term exposure as given in the table 5. No, there is one special case more. In case you are classifying the banks, you are classifying the counterparty into grade A, grade B, grade C. On what basis? You are classifying on the basis of CRAR, CET1, leverage ratio. But what if the banks in which you are investing, okay, so they do not publish their CRAR and there is no capital adequacy norms in that country. So first thing you will do, you will obtain the necessary documents and try to compute the CRAR. And if it is not feasible, then you should apply a risk weight of 350%. Okay. And if the exposure falls under speculative unlisted equity, then this rises to 400%. It's obvious, it's a risk class. Okay. So, friends, I will pause now. So, we have covered the beginning of chapter 3. Starting, we will continue from here in the next video. We have covered till now domestic sovereigns, foreign sovereigns, PSCs, MDBs, BIS, IMF, okay, and exposures to banks. Okay, including ECRA versus SCR. Okay, now before we move to the next big section, exposures to corporate, I'm going to pause here because the video is becoming too long. In the next video, we will cover the remaining exposure classes, and I will also use active learning back to this entire concepts regarding questions, and we will further smoothen the understanding because it's a more interactive learning. Right, friends? So I will meet you in the next video, and thank you once again for watching and giving your time. Do like and subscribe the video if you really like the video, and Jai Shri Krishna once again. Thank you very much.